So you're moving goods across international borders, in or out of the UAE. Let me tell you, it's not just about logistics. You're actually navigating a pretty complex world of tax. Today, we're going to break down exactly how UAE VAT works when a physical good goes on a journey.
Just think about it for a second. You've made a sale, the product is packed up, it's ready to ship out, but the million-dollar question is, who gets the tax money? Is it the country you're selling from or the country you're selling to? You know, getting this wrong can be a really expensive mistake. And the answer? Well, it all comes down to one single fundamental concept.
Okay, let's get right into it. This term, place of supply, it's basically like a GPS coordinate for your sale. It pinpoints the exact location on the map where your transaction is officially considered to have happened, just for tax purposes. And once you know that location, you know exactly which country's VAT rules you need to play by. It is the absolute key to this entire puzzle.
So here's our roadmap for today. First, we're going to lock in that GPS coordinate for VAT. Then we'll follow the journey of goods as they leave the UAE and then as they come into the UAE. We're also going to cover the super important paper trail you need to have. And then to wrap it all up, we'll do a quick quiz to see what's stuck. Let's do this.
Right, so let's get our bearings. This whole idea of place of supply, this is our foundation. Every single rule we're about to talk about is designed to help you figure out where on the world map your sale officially takes place for tax.
Let's kick things off with goods heading out of the UAE. Now, it's not a one-size-fits-all deal here. The rules are actually pretty different depending on where those goods are going. This is our tale of two very different kinds of exports. So, for our first scenario, imagine a UAE-based company selling these gorgeous luxury bags to customers over in the Kingdom of Saudi Arabia. Now, for that, KSA is what's known as a GCC implementing state. All that really means is it's a fellow GCC country that has its own VAT system that talks to the UAE system. And believe me, that little detail is absolutely crucial for what comes next. And here it is. This number is everything. 375,000 Saudi riyals. This is the mandatory VAT registration threshold in KSA, and it's the magic number that changes the game. Your total sales to customers in that country are measured against this exact threshold.
So here's the bottom line. As long as your total exports to those non-VAT registered customers in KSA stay under that magic number, your tax UPS points right back to the UAE. Simple. You just charge 5% UAE VAT. But the second you cross that threshold, the place of supply literally shifts countries. Your GPS now points to KSA, and you are legally required to register for and start charging KSA VAT.
Okay, so that covers the neighbors. But what happens when you're exporting to a country that isn't a GCC implementing state? You know, like the US or Japan or anywhere in Europe? Well, the logic does a complete 180.
For these kinds of exports, we use a concept called a zero-rated supply, and this is just a brilliant piece of tax policy. It means the sale is still technically part of the VAT system. It's taxable, but the rate you actually apply is 0%. This is huge because it lets UAE exporters stay competitive on the world stage while still being able to claim back any VAT they paid on their own business expenses.
All right, that's goods going out. Let's flip the script. What happens when goods are coming into the UAE? The government still needs to collect its 5% VAT, but the way they do it is, well, it's pretty clever.
I mean, this is the big puzzle, right? How can the UAE tax authority possibly force a company in, say, Canada or Lebanon to register for and pay UAE VAT? The short answer is they don't. They have a much smarter system in place.
And this quote right here is the key to the whole thing. The law basically says, for tax purposes, the UAE business that's importing the goods is treated as if they are both the seller and the buyer. You're basically selling the goods to yourself. I know, it sounds a little weird, but it's actually an incredibly elegant solution to the problem.
This whole system is called the reverse charge mechanism. So instead of the overseas seller charging you VAT, the responsibility for the tax gets reversed onto you, the buyer. You're the one who calculates the 5% VAT due, and you declare it on your own VAT return. In effect, you handle the VAT for them.
But hey, this isn't just automatic. You've got to meet a few key conditions to use this mechanism. First, you absolutely must be VAT registered in the UAE when those goods arrive. Second, you got to have all the details ready so the tax authority can verify the import. Third, and this one's a big one, you have to give your VAT registration number to customs. And finally, of course, you've got to play by all the other rules the authority has. Now, for any of this to work, whether you're zero rating an export or using the reverse charge for an import, you need proof. The tax authority has to be 100% certain that those goods physically cross the border. And that brings us to the all-important paper trail.
You're going to need two types of evidence to prove those goods made the trip. First up is official evidence. That's the paperwork that comes directly from the Customs Department. Then you also need commercial evidence, and these are the standard shipping documents you probably already handle, like an airway bill for a flight or a bill of lading for sea cargo. You need both to make your case.
All right, we have covered a lot of ground. You know about place of supply, that magic number for GCC sales, zero rating, and the reverse charge. So let's see if we can put it all together. It's time for a lightning round.
Okay, on the screen you'll see 6 different transactions. For each one, you just need to decide what it is. Is it a sale to an implementing state, a purchase from one, a standard export, or a standard import? Go ahead and hit pause for a moment and see if you can tick the right box for each one.
Okay, time's up. Let's see how you did. Number 1, selling apples to KSA. That's a sale to an implementing state since KSA is a fellow GCC member. Number 2, buying hats from Canada. That's a standard import, where you'd use that reverse charge mechanism. Same goes for number 3, lamb from Lebanon, another import. But number 4, selling toys to the USA, that's an export, because the US isn't a GCC implementing state, so this would be zero rated. Number 5, coal to Siberia, also an export. And finally, number 6, buying oranges from Qatar is a purchase from an implementing state. So how'd you do?
So let's do a super quick recap of the essentials. 1. Your VAT GPS is the place of supply. It tells you which country's rules to follow. 2. For exports to other GCC states, watch that SAR 375,000 threshold like a hawk. 3. For all other exports around the world, the supply is zero rated. 4. When you're importing, you use the reverse charge mechanism. And 5. For everything, always keep your paper trail of official and commercial evidence.
We've just mapped the entire journey for physical goods. But it gets you thinking, right? What about services? When you sell consulting or software or design work across borders, there's no shipping container, no bill of lading. So where does the tax GPS point then? Does it point to the supplier's location or the customer's? That's a question for another day.